Hi, everyone, and welcome to the DFM Monthly Update. Starting with the market, the January inflation print in the US of 6.4 was higher than the expected 6.2%. The Fed turned more hawkish, and market participants started pricing in higher interest rate hikes in the next coming meetings. In South Africa, being grey-listed by the Financial Actions Task Force, as well as the unending load shedding problems, proved to be a challenge for domestic assets. On the back of this, SA equities sold off 2.3%, while SA property shared 0.1%, SA bonds fell 0.9%. Global assets produced positive returns in rand terms, but if one takes a closer look at those returns, you would see that it was really the sell-off in the rand that gave you the returns. In US dollar terms, global assets also produced negative returns. Looking at the models, most of them produced muted performance in the month of February. In relative terms, they performed largely in line with the benchmarks, which is peers in this case. And when we look at the one that really stood out, it was the Flexible Growth Fund. And it was the exposure to offshore assets sitting at about 66% that contributed the most to that 1.7% return that the model produced. There were other notable performers in the month. In flexible income, it was Amplified Strategic Income that stood out, with bonds maturing in less than 3 years, sitting at 40% in that fund. It really benefited from that. And again, higher exposure to offshore assets was another contributor to its performance. Bateleur Flexible stood out in 3 of the models, in stable, moderate, as well as high growth. It was its stock selection decisions in the SA equity component that helped its returns, with the likes of a BTI and Bidco being some of the shares that did very well in February. The fund also had high exposure to global equities. We had 2 funds that struggled in the month, those being Prescient Income Provider, as well as Loriam Flexible. In the case of Prescient, it was their exposure to fixed rate bonds, as well as very low allocation to offshore assets. In Loriam's case, it was their preference for higher equities in a month where equities sold off that had their performance. In the Flexible Growth Fund or model, the BCI Fund Smith Equity Feeder Fund did very well, again with growth continuing to outperform value in 2023. It was not surprising that that particular fund stood out. In terms of the outlook, expectations that the US Fed will pivot sometime this year are slowly dissipating. The strong jobs data from the US has kept inflation high to a point where market participants are now starting to talk about a 50 basis point hike in the next Fed meeting. However, not all is lost. The blanket sell-off of companies has made the environment quite opportune for active management. When you look at the M&A activity in the last couple of years, it does also point to an environment where assets are cheaply priced. We have stock pickers in the funds that are really capable of taking advantage of these stock picking opportunities that are being presented by the market. And we believe that the models stand to benefit from having exposure to those good stock pickers. We thank you for your continued support and look forward to engaging with you again in the next month. Thank you.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.